This is the second installment in our series, Dollars and Cents in the Caribbean. My name is Marjorie Wharton, and I am your host for this evening. My organization, Breakthrough Performance Coaching, is an organization established in Barbados, and we are designed to help managers and business owners put themselves in a position to perform at a higher level and to be able to achieve the results that they want. And so part of what we do is to bring information to people who want to develop either on a personal or a professional level. And so, as part of that objective, that intention, one of the things that I have been fortunate enough to do is to collaborate with experts, people who are experienced in their field, who come with a vast amount of knowledge and a passion for the topic that they're dealing with. And so, this series, Dollars and Cents in the Caribbean, is the brainchild of our presenter this evening, the real host for this evening, the one who's doing all the heavy lifting, Marcia Cyrus. And Marcia is a finance professional with many years' experience in banking. She's also worked as a lecturer, as a trainer. She's a consultant. She works with individuals and businesses. And she is passionate about the topic of financial literacy. And so, in conceptualizing this initiative, what she identified as her objective is to really ensure that a wide cross section of people across the Caribbean understand the basic financial principles, the concepts, and so on that affect their wealth or their ability to build wealth, and really put them in a financial position to be independent and to be wealthy as they move forward. And so, as I said, this is the second installment. Now, as we go through our session this evening, please, if you have questions, put them into the chat. And so, without further ado, I'm going to hand over to Marcia, who's going to take us through our topic this evening, debt and debt management. So, Marcia, the floor is yours.
Thank you, Marjorie. It is a pleasure to be here. I'd like to welcome all of you. Like Marjorie said, I'm really very passionate about this area, having worked in banking, investments, and financial services in general with over the years. I have really seen a lot of the fallout from a lack of knowledge about financial matters, and I have seen the impact it has had on persons who, because of ignorance, didn't manage themselves as best as they could. So this is an effort by our teams, Marjorie's team and my team, to really sensitize Barbadians and Caribbean people about financial matters, how they could possibly minimize some of the negative or the downsides of some of the actions they take, and really build wealth. As you know, the Caribbean is known as one of the most indebted regions in the world. And even though sometimes we try to separate ourselves from government, the reality is that we also, our actions, I should say, also become a drag on government. If you were with us last time on May 19th when we launched the series, we took an overview and looked at several different areas in the financial literacy space. However, this evening I thought that this area of debt management is very topical, and I thought that I would share a few ideas with you on how best you can possibly, first of all, identify and really analyze what's happening when you go into debt, how to really stay away from or stay with the good debt, and also how to manage yourself out of it if you found yourself in a crisis, and eventually to stay away from it and to manage it a lot better. There are a number of topics that I would like to cover: the psychology of debt, types of debt, loans, credit cards, etc., good debt versus bad debt, how do you qualify for a loan, why credit history is important, calculating your net worth. Budgeting is something I'm going to touch on very briefly, but in a subsequent presentation, I'd like to really tackle the subject of budgeting. I'd also like to talk about getting out of debt, the methods that are available There's several methods, but these are two that are very popular and that I will talk about a little bit more. Even give you an example of how it can work and what the results are. And then we'll talk about that consolidation, and finally we end up with staying out of debt. Being in debt is very challenging, and we hear a lot about debt and the debt trap. But the reality is, and the financial crisis in 2008 really brought it home for Barbados and the Caribbean. I remember I was working at the bank back then, and one of the things that I noted were the large number of properties that were repossessed during that period. And some of these individuals were not were well-to-do people. I remember there's a place in Bahamas on New Providence where Nassau is the capital of New Providence in Bahamas. And there's a place called Lyford Key. It's kind of like a sandy lane, but really upscale. I mean, like massive properties. There were several of those properties that had to be repossessed. And we had a similar situation here in Barbados where we did have a large property that the millionaire owners, they had property, they're very wealthy, but the crisis really affected them negatively and they walked away from the property here. So, and that sold at a fire sale. So this challenge of debt is real. And I think the various crises that we have gone through over the years has really highlighted that. I was looking at a report from the IMF, and it was looking at NPLs, which is the non-performing loans in the region. During that period, that financial crisis period, those loans jumped to about 15%, which is about 3 times the average. And so they talked about the social and other impacts that had on the Caribbean. Bahamas was probably in the top there, along with St. Kitts and Dominica, about 15%. Barbados was slightly lower at 10%, but if you ever go to any of the commercial banks and you look at the sites, you can see the number of distressed properties that are there at any point in time. And I dare say that the crisis that's taking place now with the coming out of COVID is probably gone back up there as well. Now, a couple of signs, if you are thinking, am I in that distress or that you can look for. And one of them is if you're using your credit cards to pay for living expenses, that is a sign. Using your overdraft protection on your checking accounts to pay monthly bills, that's also a red flag. Using savings to pay bills, using one credit card to pay another, delaying one bill to pay another overdue bill. The Americans call it floating, but we call it by another name. You just hide one bill and you pay the other one. Paying only the minimum due on credit card accounts, which is a very dangerous move. Using payday loans, or we have some loan sharks here in Barbados too. I wouldn't call the names, but we do have. Being over the limit on one or more lines of credit, and delaying medical and dental visits because you don't have enough cash to pay for them. These are all signs that you may be in distress. If you answer to one or more of these, you really need to start doing some psychological analysis of what's happening with you and debt. So, as we know, too much debt can have a adverse impact on your emotional health, on your well-being, and even your mental health. And we've been hearing a lot about the negative fallout from mental health because of this COVID situation. And to be honest, because so many people are unemployed, this has really led to deterioration in their mental health. I mean, if you can't pay your bills, if you can't buy food, if you can't send your children to school, it really does have a serious impact on you. So these are some of the issues that outside of a situation like this, which would have impacted at least 93% of the world, you really want to always be assessing where you are because you don't want to fall into a depression. Your money personality is also something that you should really consider. You need to look at your spending habits, your savings habits, your relationship with money, your emotional well-being at that time and how you manage your overall finances. And coming back to emotional well-being, some of us go shopping when we are really depressed. We want something, buy a lot of items, but that is the wrong time. If you are feeling a little depressed, find someone to talk to, engage in some other type of activity other than going and shopping on Amazon or wherever. So just be mindful of the triggers. I should also add here the friends that you keep is also another important factor, because if you are hanging around with friends who are constantly spending, who are constantly eating out, that may also have an impact on you if you are going through some financial challenges. Let's look at some of the money management styles. One is living beyond one's means. That is when people spend more money than they have, right? And that's not where we want to be at all. Living at one's means is when people spend only the amount of money that they have. They use credit occasionally and usually don't have savings accounts because they spend the entire amount of money they have each month. That's not necessarily where you want to be either. You want to be able to build in an emergency fund and some type of savings, because as long as we are all alive, there will be things that happen that we didn't expect. So we should really have some savings and an emergency fund as well. Living beneath one's means, and this is where you can probably use Warren Buffett as an example. He's one of the wealthiest men in the world, but yet he still lives in the house that he lived in 1950s. He still drives the same car. I think it's a little bit extreme, but he's one that lives way beneath his means. So you should have, if you're following this particular style, you should have lots of savings around to engage in spur of the moment events with your friends. I'll switch on here and talk about the types of debt. And there are two major types of debts. One is the amortizing type, and one is non-amortizing loans. So the amortizing loans, those are like things like car loans, mortgages, personal or consumer loans. And then the non-amortizing loans, those are the credit cards, the interest-only loans, the balloon loans. All those are types of revolving type debt, especially in particular the credit cards. So I'll talk about the different types here at this point. Overdraft protection. If you write checks that exceed the amount of money you have in your checking account, overdraft protection will honor them instead of bouncing them for insufficient funds. And I recall vividly when I worked at the bank that we got this overdraft report every morning on those persons who had overdraft facilities and had exceeded them. And we had to call these individuals to let them know, well, you've exceeded your limit. And it was amazing the type of feedback we would get. Some people say, well, my children have to go to school. This has to happen and that has to happen. But they were not managing the facilities because basically, if, for instance, if you had a $1,500 limit, but every week you were exceeding that by $500, that was an issue. So the challenge though that exists is that the persons in the bank, who may include loans officers and your relationship managers and so on, they will try their best to try to get you on the right path, but they don't have the time. Everything is measured within the bank, so they have to process a certain number of loans and so on. So they don't have the time to sit down and counsel you. So that is some of the challenges that you have. So it is really critical that as a consumer of loans, of any banking product, that you understand what you're getting into and how you should manage it. And of course, associated with those overdraft facilities, there are extra penalties that are associated. So it makes it, you kind of like really makes it difficult for you to get out of it. As you know, a debit card is a plastic card that allows you to withdraw your cash or make payments. I remember a couple of years ago, about 3 years ago, we had a financial literacy camp for teenagers, and I asked them, what is a debit card? And everybody knew actually what was a debit card, but they didn't know what was a credit card, because that was the follow-up question, was a credit card. And they speculated and they speculated, but they kind of like tossed it around, and the descriptions they give were similar to what is a debit card. So it is very important that you understand that there is a big difference. So a credit card really is a plastic card that allows you to borrow cash and make payments. Even if you may not have the cash available, you may repay the balance owing quickly or over time. Problem is that credit card is one of the fastest growing debts in Barbados, apart from mortgage debt. and in the Caribbean. And like, for example, over a 20-year period, it's grown from about 93 million to about over $300 million. So there's been evidence that we are using the credit cards a lot more. And this is especially on the personal side, because the significant growth is on the personal side. Then there's a line of credit, which is similar to a credit card, usually used by companies, allows you to borrow money when you need it and repay it over time. And we all know loans or mortgages. Banks lend people money to purchase vehicles, to purchase homes, to start businesses, etc. So, good debt versus bad debt. I had a conversation recently and we had an argument as to whether some debt is good or some debt is bad. And I have to conclude, and I have to state really strongly that there is good debt and there is really bad debt. So, the category, if you were going into debt to generate funds to make an investment, it's fine, because you have some indication that there will be a return on these funds that you're borrowing. So that is fine. Loans for a real estate property, where you know you're going to be getting some type of rental income from it over a period of time. Business loans, and it can probably even service itself. Business loans, to maybe you need working capital loans and so on to keep the business running, or to retool the business so that it becomes a lot more efficient. Education loans, and I put an asterisk, are very much aware of some of the situations with the student revolving loan, but education loans are very important for persons who want to improve themselves and invest in themselves educationally. And home loans. And I have to say here, home loans, I'm a little ambivalent about home loans, only because I am aware that the length of a home loan is so long. I mean, in most cases, we're talking about a loan that may stretch as much as 25 years. It's a long period. So if you had a $100,000 loan, for example, after I think is 5 years, you really have not put a dent at all in your principal. I know it's nice to have a beautiful home and have all the amenities. I remember vividly there was a couple that had a mortgage that was issued by the bank, and they wanted to have an additional loan to build the fence, to pave the driveway, furnish the house, landscape, all these things. And they were not approved for that. And they were rather upset, and they went to another bank and they managed to get the loan. 2 years later, they came back and asked if they could consolidate that loan with the mortgage. And of course, it was a no, really, because I think that what happens is that we, at the time when we are purchasing our homes, we get really excited and we don't realize how much it really costs to run a home. In the first 2 years after having a mortgage, it's pretty tough. It's pretty tight with money. So I really encourage all of us not to overextend ourselves with home loans. So, for example, if you were approved because your income and so on, you were approved for maybe $300,000, it does not mean that you have to go and acquire property that's $300,000. If I were you, I would go way below that. Dive under, maybe go for 250 or closer to 200,000. It gives you a little room because a house is always calling for something. I'll talk about that a little bit later. Some of the areas of bad debt would include the credit cards, and I mentioned that just now, where we are using credit cards, which are usually anywhere from 20% and up, maybe as much as 26% interest rate, which is always revolving. And remember, it's a revolving loan, and if you're just paying the minimum balance, you're never really going to touch the principal in a hurry. So I have an example I'll show you later where it will take you significant amount of time to repay that loan if you're paying just the minimum. Payday loans, I also mentioned that, and there are many of those institutions that I've seen cropping up in Barbados within the last 5 to 10 years, and car loans. And I put car loans only there because unless you really can maintain a vehicle, I mean, pay the insurance, maintain it whenever it needs, every 10,000 miles or whatever, take it to the mechanic or to the workshop to get it fully serviced. Unless you are able to do those things comfortably, it really can be a real drain on your pocket. So that's why I put it on the bad debt. I just give you a few examples of what is good credit, what is bad credit, and what another option that you can look at. So example of good credit, you can, if you had to make a purchase of $1,000 and the interest rate is 7%, you're making a minimum payment of $10 and you have 12 years to pay it off. Overall, you would have paid an interest of $440. So the actual cost is $1,440. Now, this bad credit example is really a credit card. Purchasing at a rate of 27%, your minimum payment is 23 years. It will actually take you 12 years to pay that off, and you would have paid $3,312, the actual cost. Suffice to say that paying the minimum amount per month is really not going to allow you to pay off that debt in a hurry, and it's very expensive debt. Another alternative that you could consider is purchasing with your savings, like our grandparents did. They saved up until they had enough money to make that payment. So this is, in this case, you would have saved, you have had to save $125 a month and for 8 months, and then you would have been earning some type of interest on your savings account. Maybe at this time, given that we are only earning about 0.01%, you may not actually get $30 in an 8-month period. Some key facts about loans. The loan is made up of two parts: interest costs and principal. In the first, I would say, 10 years of the loan, most of the interest of a 25-year loan, for example, the majority of that payment is going towards interest. You'll only start to see a dent placed in that after a 5-year period. I would encourage any of you who you wanted kind of, if you're thinking about getting a loan and you want to kind of have an idea of what this would look like, you can go on Excel, go into new and type in loan amortization, and you can pull that up and you can put in the loan amount, the interest rate, and the start date, and it will give you an indication of how that loan payment is split up over the period. So you'll be paying the same amount each month, but it's the allocation between the interest and the principal will change each month. And as you come closer to the maturity of that loan, you will notice that the amount that goes to principal will increase significantly. So interest costs, as I said, are higher at the beginning of the loan. There are two types of methods that are used in calculating the interest rate and the loan amounts that certain banks, certain institutions use. I tend to find that the credit unions tend to use the reducing method, and it makes it a lot cheaper for you because with the flat rate, the customer is paying based on the full loan amount. However, with reducing rate, as the loan amount reduces, the interest rate is applied, so that it makes it a lot cheaper if you have a reducing rate loan. So in this case, if you had a loan amount of 6%, same coupon rate of 7% in both cases, period is 12 months. You can see the calculation here. In the case of the flat rate, you would have paid $420 in interest, whereas with a reducing rate method, you would have only paid $229. So please answer question when you are going to negotiate a loan. What type of loan is it? Is it a loan on a reducing balance or is it a flat rate loan? This is an example here of some of the requirements that one local bank asks for when you're applying for a loan. For example, they will ask you for your ID. They will ask for proof of address, which could be a telephone bill, a water bill, electricity bill, a letter from your employer, or if you are self-employed, you may have to provide some type of financial information, which indicates that you can support the payments. And usually 3 months recent bank statements. I don't think bank references are as popular as they used to be. I just put it in here, but it is not as popular. The banks now require that you have some evidence of some activity, so they kind of see what kind of average balances you tend to hold on your account. And in terms of if you are buying a property or if you are constructing a property, there's some other requirements that are needed. You might need an agreement for the sale if you're selling a property. You might need an estimate for if you're constructing. You'll need to plan, and you need to have approved construction plans. You need to have an estimate to show the breakdown of stages of the construction. And you also, if it's a standing property, you will need an appraisal of the property. Whether you're buying or building, you will still need that. At every stage, you're going to have a quantity surveyor to do some type of assessment to keep the bank or the financial institution aware of what stage the property has reached so that they can determine the disbursement of the funds.